All right, everyone, I got a special YouTube video for you today. I want to address some comments that I've been seeing on social media, but before I do that, I have 3 things to request of you. If you like my channel, number 1, subscribe to it. Number 2, like this video. And number 3, share it with your friends. I would be forever grateful. So now, I want to talk about the elephant in the room. And I'm seeing comments where I hear, well, losses don't matter in the long run, blah, blah, blah. Or losses, you know, I think everyone's so dismissive of losses. Or I'll hear things like that imply that it is risk-free to invest in the stock index. It is not. So I want to explain that and explain why. Here's my little whiteboard here, and I'm going to use to illustrate a point. These are different percentage losses that you could have in a portfolio. And yes, you can have a 50% loss. The market has gone down over 50%, 2008, 2009 being the last big example of this. So what you see here is here are the different loss amounts. And this is up here, the gain that you would have to get from that point to be made whole again. So 5% loss, you need a 5.2% gain. A 10% loss, you need 11% gain. 25% loss, you need a 33% gain from that point to be made whole. And then 50%, you have to, at that point, you have to double your money. You have to have 100% gain again. And you might think, okay, you know, big deal. 50% loss, that happened in 2008, 2009. I was working, there were people that were about to retire, had a portfolio, we'll say $1 million, $1.5 million in a 401k, cut in half. What does that do to your retirement? What does that do? That sets you back. Because now all of a sudden you have these plans that you're gonna retire, let's say at 60 or 65 or whatever, and now all of a sudden you realize now you got $600,000, $700,000 that you don't have. That's a big deal. And that's improper risk management. I mean, they probably should have had a financial advisor. I don't know what other assets they had. All I knew is like when they talked about their 401ks, this is what they talked about. But still, there's panic. And this is exactly why you never want to be dismissive of losses, because losses hurt more than the gains. And this is exactly why. And I don't want to hear people get dismissive about it. It is too important to not ignore. This is why you always must manage risk. And you might be asking, well, how do you manage risk? My thought is you invest in diversified asset classes that don't necessarily correlate. In other words, if US stocks are doing well, do emerging markets. You know, invest in emerging markets, invest some in international stocks, because US might be in a slump, but international might do well. Same thing with bonds, crypto, rental properties. What happens if stocks are doing bad, but crypto's on a run? That helps smooth your volatility out, right? That's what you want. You want to manage risk. And I cannot stress that enough. So hopefully you got a lot of value out of this video. Again, please manage your risk. Do so. Be careful with that. And if you don't know how to do that, please, you know, talk to a financial professional, talk to your advisor if you have one, and do your own research. But please, please, please manage your risk and be mindful that losses matter. They absolutely do matter. So if you got, like I said, if you got a lot of value out of this video, I'd appreciate it. If you like it, subscribe, share with your friends. Thanks. Have a great day.